Here's a brutal truth you're not going to hear from your broker. Most traders don't go broke because they can't find good entries. They go broke because they don't know how or when to leave. You probably recognize this pattern in your own trading. You spot a clean setup. Trend is aligned. Volume confirms. You enter, and within minutes you're green. Your P&L flashes numbers you like. You feel smart. You feel early. You feel in control. Then something small happens. Price hesitates. A red candle appears. You tell yourself it's just a pullback. You were up $800. Now you're up $500. Then $300. Then $50. You watch the profit shrink tick by tick, but you don't hit the sell button. You want that original number back. You want just a little more. By the time you finally can't stand the pain, the trade is flat or red. You exit not because your plan told you to, but because your nerves gave out. You didn't lose to the market. You lost to your exit. Or the flip side. You enter, and price immediately moves against you. You plan to risk 2%, maybe 3%. But when your stop level approaches, your finger freezes. You widen the stop just a bit. You tell yourself the market is shaking out weak hands. You watch a small planned loss turn into a bleeding wound that threatens your entire account. That is the amateur script. Emotional exits. Negotiated stops. Profit taken too early. Losses cut too late. Professionals run a different movie in their head. Jesse Livermore made and lost multiple fortunes before he cracked the code. When he finally did, he turned $20,000 into $100 million in 18 months during the 1929 crash. The difference wasn't better entries. It was 3 exit rules that saved him from the psychological traps that destroy everyone else. Here's what separates amateur from professional. The amateur obsesses over where to buy. The professional obsesses over where to sell. The amateur plans the trade. The professional plans the exit before the entry even happens. Think about your last 10 trades. How much time did you spend finding the perfect entry? You probably studied charts for hours. You waited for confirmation. You checked volume, momentum, maybe even sentiment indicators. You wanted everything aligned before pulling the trigger. Now ask yourself this. How much time did you spend planning exactly where and how you'd exit? Did you write down specific prices before entering? Did you have a clear protocol for taking profits in pieces? Did you know the exact conditions that would signal you were wrong? Most traders spend 90% of their preparation time on entries and 10% on exits. Then they wonder why their results are inverted. Small wins and large losses. Let me prove it with numbers. Say you buy a stock at $50 on a breakout. It's not the perfect entry. You're a quarter point late. An amateur panics about that imperfection. Now the stock runs to $60. You have 10 points of profit on a slightly imperfect entry, but you don't have a clear exit plan. Fear takes over. You exit at $52 because something feels off. You made 2 points. Meanwhile, a professional buys the same stock at 51, a worse entry than yours. But before clicking buy, they wrote 3 numbers on paper: entry at 51, exit if wrong at 48, target at 60. When it hits 60, they sell 1/3. When it extends to 65, they sell another 1/3. They trail the final 1/3 and exit at 62. Their average exit is $62. They made 11 points on a worse entry. The entry was irrelevant. The exit protocol was everything. Most trading education is backwards. You're taught to hunt perfect breakouts and tight stops. But Livermore discovered something counterintuitive. Your entry is almost irrelevant if your exit strategy is broken. You can enter at terrible prices and still win big. You can enter at perfect pivots and still lose everything. Why is exiting so much harder than entering? It comes down to 2 primal forces: hope and fear. But in trading, these emotions are wired backwards. When a trade goes against you, the amateur feels hope. You hope it will come back. You hope it's just a shakeout. You hope you can get out at break even. This hope is poison. It keeps you in a losing position until the pain becomes unbearable. When a trade goes in your favor, the amateur feels fear. You fear the profit will disappear. You fear you'll look stupid if you let a winner turn into a loser. So you snatch the small profit. You take the crumbs off the table while the professional eats the whole meal. Livermore realized that to win, You must reverse these natural human instincts. You must fear the loss and hope for the profit. You must be terrified of a small loss growing into a big one, so you cut it instantly. You must hope that a small profit grows into a windfall, so you give it room to breathe. Think of your capital as inventory. If you ran a shoe store and you bought a line of shoes that nobody wanted to buy, would you keep them on the shelf for 5 years, hoping fashion would change? No. You would mark them down, sell them at a loss, clear the shelf space, and buy shoes that people actually want. Yet as traders, we hold on to our bad inventory, our losing positions, hugging them tight, refusing to clear the shelf space for the winners. We tie up our mental capital and our financial capital in dead money. The 3 rules you're about to learn aren't complex indicators or secret patterns. They're psychological protocols that force you to act when your emotions scream the opposite. Livermore called them his survival trinity. Wall Street called them the reason he could walk away from crashes that destroyed legends. Rule 1 will feel wrong every time you use it. It demands you exit when your brain is screaming for just one more minute, one more tick, one more chance to be right. It requires you to treat your stop-loss like a fire alarm, not a suggestion, not a guideline, but an immediate evacuation order. Rule 2 contradicts what every broker teaches. You've been told to let winners run and cut losers short. That's half right. But how do you let winners run without giving back all your profit? How do you know when letting it run becomes hoping it recovers? The second rule gives you a precise protocol for taking money off the table in a way that captures extended moves while protecting capital. Rule 3 requires you to fight your own success. This is the hardest one, because it demands patience when you're winning and ruthlessness when you're stagnant. It separates traders who catch big moves from traders who get chopped to pieces. Most never learn this rule because it requires you to think in campaigns, not candles. Pay attention, because there's one specific exit signal Livermore used that modern algorithms still can't replicate, a signal that often kept him in winners longer than his fear wanted, and out of losers faster than his ego allowed. It's not price-based, it's not time-based, it's not indicator-based. It's a structural signal that reveals when the character of a move has changed, even when the price looks identical to 5 minutes ago. That's coming in Chapter 3. But first, you need the foundation that saved him $40,000 in a single trade during the 1907 panic. $40,000 in 1907 is roughly $1.2 million today. He saved that money not by being smarter or faster than other traders. He saved it by having a rule that removed his opinion from the equation. When most traders were negotiating with their stops, adjusting their thesis, giving positions just a little more room, Livermore was already out. Gone. Flat. Watching from the sidelines as the stock he'd exited collapsed another 30 points. Here's the identity shift that separates amateurs from professionals. The amateur thinks, I'll see how it feels when price gets there. The professional decides, when price gets there, I am out. My feelings don't get a vote. The amateur treats every trade like a fresh emotional experience. The professional treats every trade like another repetition of the same process. When you watch traders who survive decades, you'll notice something. Their entries differ. Their indicators differ. Their time frames differ. But they all share one trait. They are ruthless about exits. You are not learning tricks. You are rewriting your identity from someone who reacts into someone who executes. Rule 1 will show you how to stop arguing with losing trades. Rule 2 will show you how to stop sabotaging winning trades. Rule 3 will show you how to stay in the few rare moves that can make your entire year, and how to know when that move is truly over. The difference between the traders who make it and the traders who vanish is not intelligence. It is not capital. It is the ability to execute the exit when every fiber of your being wants to wait. So let's begin with the foundation. Let's go back to 1907, to a specific trade where Livermore learned the first and most important lesson the hard way. This is the rule that stops the bleeding before the wound becomes fatal. This is the no-argument exit that every professional knows and every amateur fights. Jesse Livermore had a simple belief that saved him $40,000 in 1907. It wasn't a complex algorithm or secret indicator. It was a philosophy that fits on a business card. If a stock doesn't act right, I don't argue with it. I get out. This is rule number 1. the no-argument exit. Professionals treat this rule like a fire alarm in a burning building. When it rings, you evacuate immediately. You don't debate whether it's a drill. You don't pack your belongings. You just leave. Amateurs treat it like a weather forecast. They listen, consider it, and decide maybe the storm will pass. Let me put you directly into this scenario so you can feel the difference in your bones. You buy Union Pacific at $160 on what looks like a perfect breakout. The pattern is textbook. Volume surges on the breakout candle. The tape feels alive with aggressive buying. You calculate your position size correctly, risking exactly 2% of your account. Everything aligns. You feel confident, maybe even a little proud of your discipline. Within minutes, you're up 2 points at 162. Your P&L flashes green numbers. You're already calculating where you'll take profits. Then something subtle shifts. The stock hesitates at 162, ticks down to 161, then slips back to 160. That surge of volume that carried the breakout starts to fade. The tape that looks so strong turns sluggish. Small lots, scattered prints. The energy drains from the move like air from a punctured tire. This is the moment where your account is either saved or destroyed. This is where amateurs and professionals reveal their true nature. Watch the amateur's internal dialogue unfold. It's just normal profit-taking. This is healthy. I'll give it more room. The market is shaking out weak hands before the real move. I did my homework. I know I'm right. This pullback is temporary. If I sell now, I'll look stupid when it bounces right back up. The amateur is having a conversation with the stock. They're searching for reasons to stay. They check news feeds. They zoom out to longer time frames looking for support levels that justify holding on. They are negotiating with reality, arguing with the tape. A professional sees the same price action and executes the no-argument exit. No internal debate. No hope. No story construction. The stock didn't act right. The premise was immediate follow-through with momentum. The momentum failed. The trade is over. Out at 159. This exact scenario destroyed Jesse Livermore in 1907, teaching him the most expensive lesson of his early career. He was already a legend on Wall Street, but even legends bleed when they ignore their own rules. Livermore bought Union Pacific at $160. Before entering, he set his mental stop at 155. He told himself clearly, if this drops 5 points, my thesis is wrong, and I will exit immediately. The market turned. Union Pacific slipped through 157, then 156. Finally, it printed 155 and 25 cents. Just 25 cents past his predetermined line in the sand. That's where he failed his own test. He stared at the screen and said to himself, it's only a quarter point past my stop. Let me see if it bounces here. It's Union Pacific, it's strong. It will come back. I don't want to be shaken out at the absolute low. That single thought, just a little more room, triggered a catastrophe. Because by the time fear finally overpowered hope and forced him to act, he wasn't selling at 155. He was dumping his entire position at 142 into a falling, panicked market. That quarter-point hesitation turned into a 13-point disaster. On his position size of approximately 3,000 shares, that was $40,000 gone. In 1907, that was enough to buy 10 houses in a decent neighborhood. Today, adjusted for inflation, that's roughly $1.2 million. Here's the crucial insight. The market didn't suddenly become unfair. His system didn't stop working. His analysis wasn't wrong. The only thing that failed was his discipline at the exit. He had the right rule. He just didn't follow it. After that devastating loss, Livermore did something that transformed his entire approach to trading. On his very next trade, he didn't just have a mental stop. He wrote his exit price on a piece of paper before he even placed the entry order. Physical ink on physical paper. He wrote entry, $110. Exit if wrong, $105. Target if right, $125. When the stock hit $105, Livermore looked at the paper and sold instantly. No thinking, no analyzing, no checking if maybe it would bounce. The decision had already been made by his calm, rational self before any money was at risk. His emotional self, the one flooded with stress hormones during the trade, didn't get a vote. The rule became religious to him. The exit price is a contract with yourself, and breaking contracts destroys accounts. Let me explain why this protocol is so devastatingly effective. It removes the most dangerous variable in trading, your emotional state during the position. When you're in a trade, your brain gets hijacked by your limbic system. If you're winning, dopamine floods your system, making you feel invincible. If you're losing, cortisol and adrenaline trigger fight or flight responses. Your rational brain, the part that did the analysis and planned the trade, gets overruled by primitive survival instincts. In that chemically altered state, you cannot make good decisions. You will rationalize. You will hope. You will negotiate. You will do anything except follow your original plan. But if you write the exit price before entering, you create what I call a decision firewall. The decision was made by your calm, analytical self. Your stressed, emotional self doesn't get to override it. Here's the protocol that every professional follows. Before risking $1 on any trade, write down 3 specific numbers. Number 1, your entry price. Number 2, your exit price, if you are wrong. Number 3, your target price, if you are right. The exit price is sacred, not flexible, not negotiable, not a suggestion. When that price hits, you are already gone. You don't wait for the candle to close. You don't wait to see if volume picks up. You execute immediately. Why does this mechanical approach beat intuition every time? Because prices are objective, but emotions are subjective. A 5% loss feels completely different depending on your context. If you're up big for the month, it feels manageable. If you've been losing for 3 weeks straight, that same percentage feels catastrophic. If you're trading with play money, it feels different than trading rent money. Your emotional experience of any loss is variable and unreliable. But $105 is always $105. It doesn't care how you feel about it. It doesn't care about your account balance or your recent trading history. It's just a number. And numbers don't negotiate. Let me give you another example from Livermore's later career that proves this point. In 1916, he bought Bethlehem Steel at $85. Before entering, he wrote his exit at $81. The stock immediately dropped to 83, then 82, then 81.5. Every instinct screamed at him to give it more room. The stock was so close to his stop. Maybe it would bounce right there. But he had learned his lesson the hard way. When Bethlehem Steel ticked to $81, he sold without hesitation. No negotiation. Out. The stock continued falling. By the end of the day, it was trading at $76. If Livermore had argued with his stop, if he had given it just a little more room, he would have watched a 4-point loss become a 9-point catastrophe. On his position size, that would have cost him an additional $15,000. Instead, he took his predetermined 4-point loss, preserved his capital, and moved on to the next opportunity. 3 days later, he found a better setup and made 12 points. That winning trade would have been impossible if his capital had been tied up in a losing Bethlehem Steel position. This reveals the hidden power of the no-argument exit. It's not just about limiting losses. It's about preserving your capital and mental state for the next opportunity. Every dollar you save by cutting a loser fast is a dollar available for deployment into a winner. Every trade you exit cleanly is a trade that doesn't haunt you, doesn't shake your confidence, doesn't make you hesitate on the next setup. Think of yourself as having 2 distinct identities, General you and Soldier you. General you makes the plan when the market is closed, when you're calm and rational, when you can think clearly about risk and reward. Soldier you executes that plan when the bullets start flying. The soldier doesn't argue with the general. The soldier follows orders. When you take a stop loss, your ego screams, "I was wrong." But the professional reframes it completely. The professional says, "I executed my plan perfectly. I paid a small insurance premium to protect my capital from catastrophic loss." Here's a simple drill to hardwire this rule into your nervous system. For your next 10 trades, write your 3 numbers on an index card before entering. Entry, stop, target. Place that card where you can see it during the trade. Your only job is to obey the card, not your feelings. When price touches your stop, exit immediately, even if every cell in your body wants to give it more space. Do this 10 times in a row without exception. You'll feel the friction. You'll feel the loss of control. But something profound will shift. You'll realize you just traded 10 times without a single uncontrolled loss. For many traders, that's the first time in their career they can say that. The maxim that captures this entire philosophy: the price is the decision. Execution is obedience. You are not paid to think during the trade. You are paid to think before the trade and execute during the trade. The amateur believes trading is about being smart in real time, adjusting to every tick, reading the tape as it unfolds. The professional knows that trading is about making one good decision in advance and having the discipline to honor that decision regardless of what emotions arise. Imagine how different your trading history would look if you had applied this rule to your 3 biggest losses. Those account-killing trades that wiped out weeks or months of progress, they all started as small, manageable losses. They all began with a stock that just didn't act right. If you had applied the no-argument exit religiously, those disasters would be minor scratches on your P&L. You would still have that money. You would still have that confidence. But cutting losers fast is only half the equation. It keeps you in the game. It ensures survival. But survival alone doesn't build fortunes. The real money, the life-changing money, comes from knowing what to do when you're right. Most traders are so focused on avoiding losses that they sabotage themselves on the winning side. As soon as they see green, they panic and grab profits instantly, terrified the market will take them back. The professional has a completely different protocol for handling winners. While the amateur is taking their first small gain, the professional is using a precise system to multiply their profits and still capture extended moves. This system contradicts almost everything your broker has taught you about locking in gains. It requires you to do something that feels risky, but is actually the safest way to trade major trends. That brings us to rule number 2, how to scale out of winners in strength while never scaling out of losers in weakness. This is the rule that separates the grinders from the wealth builders, and it's coming next. Here's the rule that contradicts everything your broker teaches, everything your trading course preached, and everything that feels natural when you're in a position. Never exit a losing position in pieces. Never average out of pain. Only scale out of winning positions, and only into strength. This is rule number 2, and it will feel backwards at first because it requires you to do the opposite of what your survival instincts demand. Read that again. Only scale out of winners. Never scale out of losers. Let me show you what amateurs do, because you've probably done this yourself. You enter a trade, and it immediately goes against you. You're down 5%, then 10%, then 15%. The pain becomes unbearable. You can't admit you were completely wrong, so you compromise. You sell half the position, telling yourself, at least I'm reducing my risk. Maybe the other half will recover and I'll get out at break even. You just violated the cardinal rule of professional speculation. You are scaling out of weakness. You just locked in a guaranteed loss on half your position while keeping exposure to a trade that has already proven you wrong. You are hoping that a broken trade will miraculously heal itself. Now watch what the same amateur does when they're winning. The trade goes in their favor. They're up 8%, then 10%. Fear floods in. What if I give this back? What if it reverses and I look stupid? I should lock in this gain before it disappears. Your broker whispers in your ear, you never go broke taking a profit. They dump the entire position at the first sign of green. 2 weeks later, they watch that same stock run another 30% without them. They captured 10% of a major move because fear made them exit everything at the first moment of discomfort. This backwards psychology guarantees small wins and large losses. You scale out of losers, keeping exposure to what's not working. You dump winners completely, eliminating exposure to what is working. Over time, this approach mathematically destroys accounts. Jesse Livermore's rule was absolute and non-negotiable. If you're wrong, exit completely at your predetermined price. 100% out. No negotiation. No scaling. If the ship is sinking, you don't put half the crew in lifeboats and leave the other half on deck. You abandon ship. But if you're right, if the stock is acting right, if the volume is confirming, if the profit is growing, that is when you scale out. You sell pieces of your position as the stock rises. You sell into the strength. Let me take you back to 1909 to show you exactly how this works in practice. This is the trade that cemented Livermore's reputation. and taught him the power of scaling out in strength. Livermore identified Anaconda Copper as a major opportunity. The entire copper sector was showing strength, and Anaconda was the leader. He accumulated a massive position, 10,000 shares, at an average price of $45 per share. That's $450,000 of exposure, astronomical for 1909. Now an amateur holding 10,000 shares at 45 would be sweating bullets. As soon as the stock hit 50, the amateur would be doing the math. I'm up $50,000. That's a fortune. I have to book this before it crashes. They would sell everything, ring the register, and go home feeling like a genius. Livermore did nothing at 50. He sat on his hands. He let the pressure build. Within weeks, the stock began to run with powerful volume. It powered through $50, then 52, then 55. This is where most traders panic and exit everything. Livermore did something different. At $55, he sold 3,000 shares into that buying frenzy. Why? Because he was following a protocol. By selling 3,000 shares at 55, he locked in $30,000 of profit. That's 10 points times 3,000 shares. More importantly, he removed 1/3 of the emotional pressure. He now had a guaranteed win on the trade, which freed his psychology to let the remaining 7,000 shares work. The stock didn't stop at 55. It consolidated briefly, then exploded higher. $60. 62. 65. At $65, Livermore executed the second phase of his protocol. He sold another 3,000 shares. That's 20 points of profit on 3,000 shares, another $60,000 locked in. Now he had $90,000 of realized profit and 4,000 shares still in play. The psychological pressure was completely gone. He wasn't hoping or praying or stressed. He was simply managing a position that had already paid him handsomely. Anaconda Copper continued its rampage. $70, 73, 75, 78. The stock finally peaked at $78, a move that few could have predicted, and even fewer could have captured. Livermore didn't try to pick the exact top. When the stock began showing signs of exhaustion, climactic volume, wide-range bars, hesitation at resistance, he exited his final 4,000 shares at $76 on the way down. Let's calculate what this systematic approach delivered. 3,000 shares at $55 gave him 10 points of profit per share. 3,000 shares at 65 gave him 20 points per share. 4,000 shares at 76 gave him 31 points per share. His average exit price was $67. His entry was 45. That's 22 points of profit per share on 10,000 shares. The mathematics. 10,000, $22,000, $220,000 in total profit. In 1909, that was enough to buy a mansion, staff it for a decade, and still have money left over. Now let's compare that to what an amateur would have done with the same entry and the same opportunity. The amateur sees the stock run from 45 to 50 and gets nervous. I should lock in this 5-point gain before it disappears. They dump all 10,000 shares at $50. Profit. $10,005, $50,000. They then watch helplessly as the stock runs another 28 points without them. Or consider the amateur who holds for the long term. They enter at 45 and hold everything through the entire move. At 78, they're sitting on 33 points of profit. $10,000, $33,000, $330,000 on paper. But they don't have a selling protocol. When the stock starts to roll over, they freeze. It's just a pullback. It will make new highs. They ride it down to 70, then 65, then 60. Finally, in disgust and pain, they dump at 60. Profit. 10,000, 15 Celst, $150,000. Livermore's systematic scaling approach captured 220,000. The early exit captured 50,000. The hopeful holder captured 150,000. The scaling method won by a massive margin, and it did so with far less emotional volatility than either alternative. Why does scaling out in strength work so much better than the alternatives? 3 reasons, and you need to understand all 3 to make this rule part of your identity. First, trends persist longer than emotions can handle. When a stock is in a genuine trending move, it will run further and longer than your comfort zone allows. Your fear will scream at you to exit long before the trend is exhausted. By scaling out in pieces, you satisfy your fear with partial profits while keeping exposure to the extended move. Second, tops are processes, not points. Amateurs think they can identify the exact moment a stock peaks. They wait for the top and then try to sell everything at that magical price. But markets don't work that way. Tops take time. They involve distribution, multiple tests of resistance, climactic volume, and eventual breakdown. By the time you're certain it's a top, you've already given back significant profit. Scaling out turns this problem into an advantage. You don't need to pick the top. You take profits at logical levels on the way up, and you let the final piece exit when the structural trend breaks. You capture the majority of the move without the stress of timing perfection. Third, and most important psychologically, taking partial profits removes emotional pressure and creates what professionals call free ride capital. Once you've locked in more profit than your initial risk, the remaining position is playing with house money. This mental shift is enormous. You stop checking the screen every 30 seconds. You stop second-guessing every tick. You let the position breathe because you've already won. Here's the protocol that every professional follows. It's called the rule of thirds, and you must implement it starting with your very next trade. Divide every position you take into 3 equal parts. Before you enter the trade, write down 3 distinct goals. The first third is your relief valve. You sell this at your initial conservative target, typically your first major resistance level, or a 2-to-1 or 3-to-1 reward multiple of your risk. If you risked 5 points to enter, your first target might be 10 or 15 points. When price reaches this level, you sell 1/3 of your position with 0 hesitation. This locks in a guaranteed profit and removes initial pressure. The second third is your wealth builder. You sell this at an extended target, usually a previous major high, a psychological round number, or a technical projection that requires the stock to prove itself with continued strength. When price reaches this level, you sell another third. Now you've captured significant profit, and you're playing with house money on the final piece. The final third is your jackpot runner. You do not have a price target for this piece. You never sell this piece into strength. You hold this piece until the trend structure actually breaks. You use a trailing stop based on structural support, or exit on clear reversal signals, climactic volume followed by failure, deep violation of prior support, or a change in the character of the tape. This final third is designed to capture those rare extended moves that turn good trades into legendary trades. If you sell everything at your first target, you will never catch a monster trend. If you never sell anything, you will watch winners turn into round-trip losers. The rule of thirds solves both problems. But remember the critical asymmetry. This protocol only applies to winners. If you buy a stock and it hits your stop loss, if the trade thesis breaks, you do not scale out. You do not sell a third. You sell 100% immediately. Why? Because if the stock hits your stop, your thesis is broken. The reason for being in the trade no longer exists. There is no strength to sell into. There is only failure, and you do not manage failure by lingering in it. You manage failure by severing the connection instantly. This requires a complete rewiring of your instincts. It feels uncomfortable to sell a stock that is going up. It feels like you are leaving money on the table. But you must reframe it. You are not leaving money on the table. You are buying peace of mind. You are buying the ability to hold the rest of the position for the big move. Think about the incentive structure this creates. When you scale out of winners, you're rewarded for being patient with success. When you exit losers completely, you're punished for being patient with failure. This is the correct alignment. Most traders have it backwards. They're patient with losers and impatient with winners. When you sell into strength, you are in control. You are dictating terms to the market. You are feeding the ducks while they are quacking, selling to the buyers who are arriving late to the party. When you sell into weakness, the market is dictating terms to you. Sell strength, not weakness. Weakness demands complete exit. You now have 2 rules that work together as a system. Rule number 1 keeps you out of trouble by cutting losers fast. Rule number 2 keeps you an opportunity by scaling winners intelligently. But there's one more exit rule that's even harder to execute, because it requires you to do something that feels completely unnatural. Nothing. The third rule is about recognizing when doing nothing is the most profitable action, and when that same patience becomes deadly. It's about understanding the difference between a consolidation that's building energy for the next leg and dead money that's tying up your capital for months. Some trades don't fail on price. They fail on time. They drift. They stall. They go nowhere while draining your focus and opportunity cost. This is campaign management, Livermore's time stop, and it's the final piece of the survival trinity that separates traders who catch big moves from traders who get chopped to pieces. That's coming next. The third rule is the hardest to master because it requires you to hold two contradictory truths in your mind simultaneously. Sometimes the best exit is no exit at all. Sometimes the worst exit is waiting too long for nothing to happen. Most traders never figure out which is which, and that confusion costs them fortunes they never even realize they lost. This is rule number 3, the time stop and campaign management. It combines two concepts that separate professionals from perpetual strugglers. The first concept tells you when to abandon a trade that isn't losing money, but isn't making money either. The second tells you when to sit on your hands and do absolutely nothing while every instinct screams at you to act. Jesse Livermore never thought in single candles or individual trading sessions. He thought in campaigns. To him, every trade was a living organism with distinct phases: initial risk, confirmation, expansion, and final exit. His rule was deceptively simple, but profoundly difficult to execute. Change your exit plan as the trade matures through structural phases, not as your emotions spike. But before we explore the art of sitting tight with winners, we must address one of the most insidious account killers in all of speculation: dead money. This brings us to the time stop, a concept most traders have never heard of, but one that could save you thousands. Picture this scenario that drains more accounts than dramatic crashes ever will. You buy a breakout at $50. Clean pattern, strong volume, proper position sizing. The stock pops to 51 on day 1. You feel smart. Day 2, it drifts between 50 and 51. Day 3, same range. Day 4, 5, 6, nothing. Just sideways chop on declining volume. Your stop at 47 hasn't been hit. You haven't lost money. But something critical has died. Your thesis. You bought expecting momentum. You got stagnation instead. The amateur looks at this and says, well, I'm not down. My stop is safe. Maybe it needs more time. They confuse not losing with winning. This is dead money, and it's killing you in 3 ways you probably don't see. First, it's tying up capital that could be deployed into a trade that's actually working. While you sit in a zombie position, 3 other setups trigger and run without you. You're not losing dollars, but you're losing opportunity, which amounts to the same thing. Second, it's consuming mental capital. Every screen check shows that flat position. You wonder if today will finally bring movement. You're distracted from finding better opportunities because part of your attention is locked on this lifeless trade. Third, it's teaching your brain the wrong lesson. You're learning to accept mediocrity. You're training yourself to view not losing as success. This is how traders drift into years of break-even results. The time stop protocol is ruthless. If the stock doesn't do what you expected within a reasonable time frame, exit. Don't wait for the price stop to trigger. Lack of momentum is the stop loss. What constitutes reasonable time? Livermore's guideline: if you buy a breakout expecting immediate momentum, the stock should show meaningful progress within 3 to 5 days. If you buy an early position in what you believe is a major trend, you should see confirmation within 2 to 3 weeks. If neither happens, the thesis is wrong regardless of price. Consider Livermore's 1914 Reading Railroad trade. He bought at $72 on what appeared to be a clean breakout, expecting a quick run to 80. His price stop sat at 68. For 10 days, the stock did nothing, trading between 71 and 73 on weak volume. On day 11, Livermore sold at $72.50 for a tiny profit that barely covered commissions. Why? The breakout had failed to produce follow-through. Time had invalidated the thesis. 3 weeks later, Reading collapsed to 62, validating his time-stop discipline. Now flip to the opposite extreme, knowing when to do nothing while your position moves against you. This is campaign management, and it requires you to think like a general fighting a war, not a soldier reacting to every gunshot. Most traders can handle losing trades better than winning ones. When you have a big winner, the urge to cash out becomes overwhelming. You're terrified the market will snatch back your profit. You see a pullback and panic. But Livermore understood something crucial. Big moves don't travel in straight lines. They surge, pause, consolidate, and surge again. If you exit on every pause, you'll never capture the life-changing move. Let me take you inside Livermore's legendary 1915 Bethlehem Steel campaign to show you exactly how this works. He accumulated 5,000 shares at $80 as World War I created massive demand for steel. Following his scaling protocol, he sold 1,600 shares at $90, then another 1,600 at $100. He'd locked in $48,000 of profit and still held 2,800 shares. Then came the test. The stock pulled back from $100 to $94 on 2,800 shares that represented $16,800 of open profit evaporating. Every amateur instinct screams, sell before it's all gone. But Livermore applied campaign thinking. He asked 4 structural questions. Is the primary trend still intact? Yes. Are pullbacks shallow compared to rallies? Yes. Is volume expanding on advances and contracting on declines? Yes. Has anything fundamental changed in the thesis? No. The structure remained healthy. He moved his stop to $88, below the consolidation but above break-even, and did the hardest thing a trader can do: nothing. For 2 agonizing weeks, the stock consolidated between 94 and 102. Most traders would have been shaken out by the volatility and uncertainty. But Livermore understood that consolidations aren't failures, they're the market building energy for the next leg. His patience was rewarded. Bethlehem exploded from the consolidation, running to $135 on climactic volume. He exited his final 2,800 shares at $132. The mathematics of campaign thinking. Those 2,800 shares gained 38 points from the pullback low of 94 to his exit at 132. That's 2,800, 38 secs, $106,400 in additional profit captured purely through structural patience. His total campaign profit, $48,000 from scaling, plus $145,600 from the final third equals $193,600 total. If he'd panicked during the pullback, he'd have captured perhaps $87,000. Campaign thinking delivered an extra $106,400. Here's the campaign protocol for your final third. Once you've scaled out 2/3, switch from price targets to structural management. Set a trailing stop below key support levels, not arbitrary percentages, but actual market structure. Hold until the trend character genuinely changes, lower highs and lower lows, climactic volume followed by failure, or deep violation of structural support. This requires a profound identity shift. In the early phase, you're a sniper. Quick, defensive, ready to cut losses. In the scaling phase, you're a merchant, taking profits, managing risk. In the campaign phase, you're an investor, patient, distant, letting the position breathe. The amateur tries to be an investor with losers and a sniper with winners. This is precisely backwards. You must be ruthless with failure and patient with proven success. The maxim that captures this paradox: trade the campaign, not the candle. Patience is a position, but only in the right position. You now possess the complete trinity. Cut losses without argument. Scale winners into strength. Kill dead money quickly, but let confirmed trends run their full structural course. These aren't just rules, they're the foundation of every fortune built through speculation. The final chapter will show you how all 3 work together in perfect harmony. You now have the 3 rules. But rules in isolation are just theory gathering dust in your mind. A surgeon with perfect knowledge of anatomy is useless without the ability to make clean incisions under pressure. The power comes from using these rules as an integrated system, Livermore's exit trinity, where each rule supports and amplifies the others. Let me walk you through a complete trade using all three rules working together. This isn't a cherry-picked winner from hindsight. This is the exact process professionals follow on every single position, whether it works or fails. You're about to see how the Trinity transforms a simple trade into a systematic campaign that removes emotion from every critical decision. You're scanning the market Tuesday morning when you spot a stock breaking from a 6-week base at $30. Volume is surging. The pattern is textbook. Every amateur instinct screams buy now before it gets away. But you're not an amateur anymore. You pause. Before risking a single dollar, you apply rule number 1. You grab an index card and write 3 numbers in ink. Entry, $30. Stop if wrong, $28.50. First target, 33. That stop sits just below the breakout level where your entire thesis would be invalidated. You're risking $1.50 per share to make at least $3 per share on your first exit. The math works. The structure works. Only now do you click buy. You enter 1,000 shares at $30. Your total risk is $1,500 if you're completely wrong. But you're not hoping or praying. You've written a contract with yourself, and you will honor it regardless of what emotions arise. The stock immediately surges with expanding volume. 31. 32. 33. This is confirmation your thesis is working. At $33, rule number 2 activates automatically. You don't hesitate. You don't negotiate. You sell 300 shares into that strength. First exit profit, stouse to 300, 33, $30, $900. You've locked in $900 and reduced your psychological pressure by 60% of your initial risk. You're no longer hoping this trade works. You've already been paid. The stock consolidates briefly, then powers higher. 35, 36. At $36, you execute the second phase of your scaling protocol. Another 300 shares sold into strength. Second exit profit sex 300, 36, 30, 1700. You now have $2,700 of realized profit, and 400 shares still working. Your initial risk was $1,500. You've captured 180% of your risk as guaranteed profit, and you still have exposure to any extended move. This is what professionals call house money. You're playing with the market's capital, not your emotional rent money. Here's where most traders destroy themselves. The stock pulls back from $36 to $34. On your remaining 400 shares, that's $800 of open profit evaporating. Amateur panic floods in. It's reversing. I should have sold everything at 36. I need to get out before I give back all my gains. But you don't panic, because you apply rule number 3, campaign management. You ask the structural questions that override emotion. Is the primary trend still intact? Yes, the stock remains well above the breakout level. Are pullbacks shallow compared to rallies? Yes, it ran 6 points and pulled back 2. That's textbook healthy action. Is volume behavior correct? Volume expanded on the rally and contracted on the pullback. Perfect. Nothing structural has broken. This isn't distribution. This is consolidation, the market catching its breath before the next leg. You move your trailing stop to $32, below the pullback low, but still above your break-even, and you do the hardest thing a trader can do, nothing. For 5 agonizing days, the stock chops between 34 and 37. Every day brings temptation to exit. Every day, you remind yourself, you're trading the campaign, not the candle. You've already locked in significant profit. Your stop protects you from disaster. Your only job now is to let the position prove what it's going to do. Day 6, the consolidation resolves explosively. The stock breaks out on massive volume. 38, 39, 40, 41, 42. This is climactic action, wide-range bars, huge volume spikes, aggressive buying. At 42, you see the critical signal. Volume explodes to the highest level of the entire move, but the stock can't push through 42.50. It prints 42, pulls back to 41, rallies weakly to 42 again, then starts to fade on heavy volume. This is your structural exit signal. Not a price target. Not a percentage. a change in character that tells you the campaign is ending. You sell your final 400 shares at $41. Final exit profit 400, 41, 30,400. Let's calculate what the exit trinity delivered. Total profit 900 plus, 800 plus, 4,400, 7,100. Your average exit price across all shares was $37.10. You captured $7.10 per share on 1,000 shares with managed risk and zero emotional chaos. Now compare this to the amateur alternatives. The amateur who panics during the pullback to 34 sells everything in fear. Their profit, $1,000, $4,000. They left $3,100 on the table because they couldn't handle normal volatility. The diamond hands amateur who holds everything but has no exit protocol watches it hit 42, then freezes when it reverses. They ride it down to 38 before finally panic selling. Profit, $1,008. Porcelain Sclalers, $8,000. They captured more than the panic seller, but endured massive emotional trauma and gave back 4 points from the peak. Worse, they reinforced the dangerous habit of hoping instead of planning. The exit trinity delivered $7,100 with systematic risk management. Not the maximum possible profit that would have required a perfect exit at 42, but optimal risk-adjusted returns with a replicable process that works regardless of your emotional state. Here's what the trinity gave you that the amateurs lacked. You honored rule number 1's discipline, though you didn't need your stop on this trade. You executed rule number 2's scaling, locking in profit at logical resistance levels while keeping exposure to the extended move. You applied rule number 3's campaign management, sitting tight through normal volatility until the structural character genuinely changed. The integration maxim: entries are guesses, exits are discipline. The trinity is survival. Understand this at the deepest level. When you click buy, you're making an educated guess about what might happen. You have an edge, a thesis, a setup, but it's still a probability, not a certainty. Your entry doesn't determine your success. Your exits determine everything. These aren't rules for maximizing every penny of every trade. They're protocols for surviving long enough to catch the moves that change your life. Livermore made $100 million, not by being right more often than other traders. He was wrong constantly, but by losing small when wrong and winning big when right. The trinity creates that asymmetry automatically. Your exit protocol starts immediately. Before your next trade, you write 3 numbers on paper: entry price, stop price, first target. The stop is your rule number 1 contract, sacred and non-negotiable. When your first target hits, you honor rule number 2 without hesitation. When you're managing the final piece, you apply rule number 3's campaign thinking. This isn't optional preparation for someday when you feel ready. This is the foundation. Think about your worst trades ever, the ones that still sting. Were they bad entries? Probably not. They were good entries that became disasters because you didn't have an exit protocol. You negotiated with stops. You held winners too long or exited too early. You traded by emotion instead of system. The exit trinity solves all of that. It removes negotiation. It removes guesswork. It removes the emotional decision-making that destroys accounts. You're no longer trading by feel. You're executing a system proven over a century of market history. If mastering these 3 exit rules has transformed how you see trading, if you're recognizing where you left money on the table or let small losses become catastrophic, then you're ready for the next evolution. Position sizing around these exits. How to bet bigger when your edge is highest while never risking ruin. How to scale your position size as your account grows without increasing emotional volatility. But master these exits first. Survival before scale. You can't build wealth if you can't survive. And you can't survive without systematic exits. The trinity is your survival protocol. Execute it religiously on your next 10 trades. Write the numbers. Follow the protocol. Prove to yourself that discipline beats emotion every time. Only then will you be ready to scale into the positions that build generational wealth.